Welcome to today's video, where we will be discussing the recession and the warning signs of a further economic slowdown. In today's world, it's more important than ever to stay informed about the state of the economy and what it means for our daily lives. So let's dive into four key topics: GDP, unemployment, the health of the U.S. consumer, and the inverted yield curve. Let's start with GDP, which is the value of all goods and services produced in a country in a given period. In Q4 of 2022, GDP grew at an annual rate of 2.9%, which is represented by the green bar on our chart. This is slightly down from 3.2% in Q3 of 2022 and 6.9% in Q4 of 2021. You can see the economic contraction during the Great Recession and during the pandemic, which was even more severe. Although the current recession may not be as severe as those, we are not yet in the clear. In Q1 and Q2 of 2022, there were smaller red contractions, which were mostly due to the trade deficit. Exports add to GDP, while imports subtract. During the pandemic, exports were down and imports were up, contributing to the contraction. Despite the GDP report, the strength of the U.S. consumer helped drive fourth-quarter gains. Consumer spending averages 68% of GDP and is at pre-pandemic levels in Q4 at 70.6% of GDP. However, the weakening housing market and cost-cutting from businesses have put some pressure on the economy. In 2023, we started the year with 2.9% annual growth, but we are on a downward trajectory and losing momentum. This is confirmed by earnings calls from companies on the stock market, where the theme is a slowing economy and slowing demand. In June, inflation hit 9.1% and the Federal Reserve raised interest rates to bring it down to 6.5%. This has helped with inflation, but it has also put pressure on the economy, as some sectors are more interest rate sensitive and feeling the pain more quickly. The real estate market is a good example, with mortgage originations down 86% year-over-year. The Federal Reserve is hoping that their restrictive monetary policy will bring down inflation and only slow down the economy, avoiding economic contraction. In plain English, they are hoping for a soft landing, which means maintaining positive GDP but at a slower rate. Now, let's talk about the labor market and unemployment. Real wages are down and continue to decline, with the purchasing power of everyday Americans falling as wage growth does not keep up with inflation. This trend is expected to continue in 2023, and unemployment is expected to rise. The tech sector announced 97,000 job cuts in 2022, up 650% from 2021. This is just the beginning, as job cuts are expected to continue, spilling over into finance and banking. The rate of unemployment is cited at 3.5%, but the U.S. Chamber of Commerce reports 2.95 million fewer workers compared to pre-pandemic levels. Unemployment reports can be misleading, as the labor participation rate shows. In conclusion, the economy is in a state of transition, and it's important to stay informed about the current state and what it means for our daily lives. The Federal Reserve is hoping for a soft landing, but there are many skeptics due to economic indicators. Regardless of what happens, it's important to be honest and have an open conversation about the state of the economy.